Well, I think the markets are kind of it's in a kind of wait and see mode, essentially, because we know we are in election season, in fact, in high season, and the next 2 3 weeks promises to be a very turbulent time in terms of trying to call the results of the election. We have to um, appreciate that the market is essentially working on a scenario where regardless of who wins, there is more fiscal largesse coming our way, and that is moderately supportive of risky assets. So it's difficult to argue that markets will break down unless we get something completely unexpected and adverse. So it is a kind of range trading mentality, but with an eye to expecting better news to come out of the US, and that is supportive for Europe and the US.
Tapan, it has been a very common theory that started to emerge around, we're heading in this direction with the fiscal monetary stimulus, so let's just see our way through the election. And it's interesting to hear you point to that as well. But short term, could we see a little bit of market volatility around a Trump or Biden victory?
I think short-term volatility is very much the prospect we're working with, simply because the election is tighter than it looks on paper. I think the polls understate the likelihood of it being a close result, and potentially if results are really close, and especially if the declaration of the result is delayed for any reason, that is the ultimately poor market scenario. But out of that box, the other scenarios still are really regarded with some confidence and assurance by markets.
Tapan, when we spoke to you back in July, I remember you said markets have extreme expectations. Extreme was a quote, direct quote from you. Extreme expectations for economic recovery here. I think it's fair to say that you've been more bearish than the markets have been. What do you think you underestimated, and how has your thinking shifted?
Yeah, we've been, I think, after the first 25–30% recovery in the US market, beyond what happened beyond that was just completely unexpected. I think not just to me, but the majority of market observers. It's the kind of decoupling that happened from what happened to corporate profits and cash flows is staggering, because if you look at credit markets, you look at equity markets, and you look at the absolute collapse in risk premiums, in terms of very high valuations for US stocks, very, very, very high valuations for US credit. And I think you get, excuse me, you get the picture of what's happened. What I think what we underestimated was the sheer power of zero interest rates and the sheer extent of the fiscal stimulus and monetary stimulus that came our way.